Today is Thursday, January 14th. This is a post-market review for the stock market activities today. The highlight of the day, of course, was the interview that the Federal Reserve Chairman Jerome Powell did, and indeed, Jerome's words managed to move the market in different directions depending on what is coming out of his mouth. And you saw a volatile session in the US dollar and the Treasury yields. All in all, you saw the dollar index retreating just by a little bit, and dollar sensitive sectors of the market did well. We're talking about materials and energy. Likewise, the 10 years Treasury yield actually climbed higher regardless of Jerome Powell's words and assurances. And you saw that yield-sensitive sectors of the market such as financials doing good, and the flip side of the coin, technology doing badly, specifically talking about big tech and high multiple tech names. Before we proceed to covering the market, let's discuss this man, Jerome Powell. He's becoming absolutely delusional, out of touch, living in a bubble of his own, and I don't know what kind of drugs Mr. Powell is taking, but he is living in a different planet right now. And he believes that he's tool man, and he got all the tools in the world to shipshape the economy the way he wants. Meanwhile, the truth disagrees, and that was apparent by the movement in the 10 years Treasury yield today. Mr. Powell says that we need to see inflation above 2% for a time. He's talking about an average of inflation, meaning that the Federal Reserve could let inflation at times run well above 2% all the way to 3%. Ask yourself a question. Take a look at gasoline prices. Take a look at commodities prices. Take a look at food prices. Take a look at housing prices. Take a look at asset prices in the equities market, and ask yourself, if we are at this point right now and we are nowhere near the 2% target according to the Fed, and we're already seeing this massive inflation in prices, what the hell is going to happen when the Fed reaches its target of 2% and beyond? For one thing, we will see out of control inflation, and asset prices in the stock market, specifically growth stocks, will completely crash due to the rise of the 10 years Treasury yield. However, this is again the Federal Reserve. They want their cake and they want to eat it too. Jerome says, don't worry, because we get tools for that too. And he's talking about, and he's teasing, the yield curve control measures, the same measures that we saw in Japan. And by the way, the results were mixed in Japan. And just so you understand, controlling the yield curve and pushing yields lower by force will come at a price, because the Federal Reserve will print money out of thin air and flood the bonds market, buying Treasury yields all over the place to push the yields down. Now remember, there is no free lunch here. The government owes the Federal Reserve for all of the treasuries they're buying, further digging this country in a deep debt hole. And why is Jerome so insistent in keeping this bubble, even if it comes at the cost of the future of this country? The reason is he wants to continue to prop up assets prices to make the rich richer. He gets his orders from certain group. Jerome is not the problem. The people behind him are the problem, destroying the country in the future for gains for the rich at the moment. And by the way, Jerome Powell keeps talking about the easing measures of the Fed, the fact that they have to continue until the Fed reaches its employment goals. Well, after adding over $3 trillion to the balance sheet of the Fed and over $7 trillion overall of liquidity flooding the market, and over $120 billion in bond purchases per month, and we are still registering about 1 million people applying for unemployment every single week. At what point does the Federal Reserve realize that they have no control over employment? This Fugazi mandate of full employment, that is bullshit. The only mandate the Fed has and able to control is protecting and propping up the assets of the wealthy, real estate and stocks. They have absolutely no control over employment. And the risk here, if this bubble pops and we see companies laying off more people, adding more pain to the jobs market and to an economy that is already scarred and fragile from the COVID-19 crisis. I know what Jerome is going to say and what you're going to say, but the Fed. Yeah, we're talking about the Fed right now. And Jerome is going to say, oh, I got tools for that too. That's not going to happen because I got tools for that too. They said the same thing back in 2000 and the bubble popped anyways. The difference is that back in 2000 when the tech bubble busted, the economy was doing a lot better than it is right now, and the overall market continued to trade normally. There wasn't a bubble in value stocks, for example. In this market, we got a bubble everywhere, and we have a fragile economy that if the bubble pops, it will add a double whammy to an already injured economy. And I know what you're gonna say. I can hear you already. But the liquidity. We have more cash and more liquidity in the system than ever. After all the liquidity that we have right now, we are still registering about 1 million people every week applying for unemployment benefits. When are you gonna get it to your head that the tsunami of liquidity does not do anything to improve the macroeconomic conditions on the ground? And the last thing I want to say about this is that Jerome keeps saying our job is to restore market functioning and to sustain market functioning. Let me ask you something, Jerome Powell. Is this market functioning? This is a monthly chart of the IWM. This is not a penny stock. This is not a tech stock. This is not an IPO. This is the old school small caps index, and look at how vertical it has traded since last year. Is this market functioning, or is this a recipe for disaster that is about to come? And this man, who's unelected by the way, controlling our economy and our fate, and he's absolutely delusional and have no clue what he's doing. Enough time wasted on Jerome. Let's move on and cover the market, and here we go. The Dow Industrial Average closing in the red, down by 68.95 points, or a decline of 0.22%. The Nasdaq down by 16.31 points, or a decline of 0.12%. The S&P 500 finishing in the red, down by 14.30 points, or a decline of 0.38%. And here are the sector's performances for the day. We're playing this yo-yo game depending on how the dollar and Treasury yields react. Yesterday we saw the inflationary trade of energy, basic materials, industrials underperforming. Today they're outperforming. And we're going to play this yo-yo game until we have a definitive, clear picture on where we're headed. So perhaps instead of doing the rotation trade segment from stay at home to reopening, because that's old already, how about we do inflationary versus re-inflationary trade? Maybe that is the new idea here. But back to the sector's performances of the day. Finishing up at number 1, capturing the gold medal, energy. Number 2 for the silver, basic materials. And number 3 for the bronze, healthcare. Meanwhile, the laggards of the day, communication services, utilities, and consumer defensives. Moving on to the performance of the futures market. And right away, we saw a slight decline for the US dollar. That was good enough for crude prices to rally today. And of course, adding to the picture, by the way, of inflation. What about softs? We see massive gains for sugar, acting sweet as it should. Lumbar rebounding, trading higher for the session. Massive gains for coffee, over 2%. And we saw decent gains here for cocoa and cotton. Meanwhile, the laggard of the day is OJ, down by about 1 percentage point. What about metals here? Once again, copper, platinum, palladium, these are the maniacs that would celebrate at any tick of the US dollar. And you saw copper prices, platinum, palladium, all trading in the green. Platinum and copper trading almost 1.5% in the green for the session. Meanwhile, the mature guy in the room, gold and perhaps silver, at least for today, being muted slightly in the red. And gold is saying, wait a minute here, don't trust the slight decline in the US dollar today. The US dollar is not finished with the short squeeze. Moving on to meats. What do we see here? Declines for feeder cattle and lean hogs. Meanwhile, live cattle is muted for the day. The good news is that meat prices are plateauing and stabilizing for now. They're still historically high, but they're stabilizing. However, grains prices are off the charts. So if you're a vegan or vegetarian, rest in peace, because you have to pay a little more here. And we saw another session of gains for soybean futures, corn on a tear, no stopping sign here. Wheat, oats, rough rice, all closing in the green, along with canola, by the way, even though you see canola in the red here. But this is a lag from Finvits. They're not updating the canola futures. So if you hold any canola futures, don't worry, they're not crashing. Canola actually finished in the green today, at least the contracts that we are tracking. Moving on to the big casino, the options market, and let's check on the tables today. How did we do? We're seeing receding volume here in the gambling activities in the options market. Perhaps the steamy money is already tied up to open trades already, and we're seeing some of of the leftover STEMI money migrating to new names. So let's cover them. The hottest table of the day is Apple, coming up number one with over 1.2 million contracts traded for the day. About 76% of those are calls. Tesla number two with a little over 770,000 contracts. About 58% of those were calls. And number three, Ford, and Ford traded over 650,000 contracts. About 82% of those are calls. And a few days ago, I told you to buy Ford because we will see another mania here. The EV maniacs pushed NIO, Xpeng, Tesla, Li Auto, all the other names to extreme valuations. And now the options premiums for these names are very, very expensive, including, by the way, General Motors. So they're looking for the new toy to play with here, and Ford is available. They got the EV play with the new Mustang. And all I did is buying shares of Ford, and I'm selling upside calls. But we also see here the other mania name of GameStop, and GameStop gained another 27% or so for today's session. We are seeing a massive short squeeze here for GameStop. Of course, shorts shorted the name because it was already dead, and there is no hope for reviving this company. All of a sudden, we have a new generation of traders whose strategy is to create gamma squeezes all over the stock market by stampeding Naruto style, buying call options on certain names. Specifically these high short interest names, hoping to create a short covering squeeze. And of course, the pumpers and the early entrants to these trades will manage to make money. The chasers will get buried because it is a matter of time before we see the dump after the early entrants made their money. Anyhow, GameStop traded over 650,000 contracts today. About 57.5% of those were calls. And check out the receding volume in NIO. And it is no surprise that NIO declining a little over 2% for the session because that money that traders were gambling with on NIO options is now migrating to other names such as Ford, GameStop, Intel, among others. Moving on to the unusual activities in the options market today, we have quite a few. At number one, we have a call options for the Brazilian ETF, the EWZ. And remember, the Brazilian economy is pretty much dependent on commodities prices, metals, grains, coffee, OJ, etc. And you're seeing the inflation of all of these prices. And somebody's making an upside bet here. The Brazilian ETF would rally 11% or so by the expiration date of February 26, and they are buying the 43 calls, and they're paying about $0.50 a piece to enter the trade. And we're gonna ignore the short squeeze mania that is going on in Bed Bath & Beyond and GameStop. Really, like these names all of a sudden, they're the future, bro. Give me a break. What's going on is market manipulation, and of course we have a dormant SEC that is just watching what's going on, and the market, as I said in my last video, is a wild jungle with no rules. What about this upside call for Uber? Buying the 60.5 calls, expiration date January 22nd, and they are paying about 55 cents a piece to enter the trade with expectation that Uber would rally over 6% by then. And by the way, they're paying big bucks for this trade, a little over $500,000. I do have a call options trade for Uber that we discussed a few weeks ago, or maybe a few days ago, depends. And I am closing this trade tomorrow. And I expect a lot of volatility to happen in tomorrow's session. Stick around for the conclusion of the video to know why. Here's another trade for Micron, the ticker MU, and they're buying the 86 calls, expiration date January 29th, with expectation that Micron would rally over 6% by then, and they are paying about $1.25 to enter the trade, bringing the total well above $1.5 million. Here's another one for Accidental Petroleum, the ticker OXY, and they are betting on more upside for energy names here, specifically the high beta names, by buying the 29 calls. Expiration date February 19th, with expectation that Accidental Petroleum would rally over 20% by then, and they are paying about 80 cents a piece to enter the trade, bringing the total once again to about $1 million. Here's another notable one for the ticker TAN. This is the solar ETF, and the solar mania is not over yet. However, somebody here is picking a top and making a bearish bet against the solar ETF, buying the 90 calls, expiration date February 19th, with expectation that the name will collapse over 21% by then, and they are paying about $1.40 to enter the trade, bringing the total once again well above $1 million. Moving on to the headlines that shaped the day, starting with macro news. And today we had the weekly jobless claims, and here it is. Massive jump in initial jobless claims to 965,000 versus 789,000 estimate. And of course, the reading was 784,000 last month. Continuing claims up to 5.27 million versus 5 million, that's the estimate, and the reading of 507 million last week. We're talking about weeks here. I made a mistake, I said in the prior month when we were talking about the overall number. It is the prior week. So in a week, we exploded higher in jobless claims. The largest increases in unemployment, we saw Louisiana, Kansas, Texas. Meanwhile, the largest decreases in unemployment claims in Illinois, California, and Maryland. Are you listening, Mr. Jerome Powell? All the cocaine that you're flooding the market with is not doing anything to help the unemployment picture. The virus is in full control here, not you and your tools, Mr. Jerome Powell. And before we move on to sentiment news, let's talk about Joe Biden's pick to head the dormant department of the SEC, the Securities and Exchange Commission. And here is the headline: Joe Biden's expected pick for the SEC has Wall Street worried. Meaning that perhaps we're going to have somebody who's going to regulate the jungle, right? Wrong. You don't need to be worried because here it is. From Goldman to the SEC. Surprise, surprise. Gensler's next stop worries Wall Street. Really? A Goldman Sachs alumni all of a sudden going to scare Wall Street? Give me a break. Moving on to sentiment news, and here it is. And this guy has a special place in hell. We talked about him before in the past. Jim Cramer of CNBC. And remember that Jim Cramer was pumping Qualcomm stock after the crash in the year 2000, urging people to buy Qualcomm and bad-mouthing Warren Buffett. And what do you know? Qualcomm busted and never revisited those prices for 20 years. Furthermore, Jim Cramer is famous for his buy bear stearns a day before the entire firm collapsed and went bankrupt. A lot of people lost money listening to Jim Cramer. But he's doing it once again here, encouraging the young retail traders on Robinhood and the likes to continue to gamble on the EV mania, the solar mania, the cybersecurity mania, whatever bubble you want to pick in the market. Jim Cramer continues to encourage and tap on the back those young traders on their risky and irresponsible behavior. Of course, when the party's over and everything crashes, perhaps we're going to see another buy Bear Stearns 2.0. And of course, Jim Cramer is doing it to pump stocks. He gets paid for doing so. He doesn't care about you retail traders. He wants to get richer and makes his buddies richer on Wall Street by your gambling behavior. And here is the clown Jim Cramer saying, market hasn't priced in the pandemic coming under control this year. Really? Take a look at the IWM from a monthly perspective. Hasn't priced that the pandemic is under control? Give me a break. We have priced maybe 20 years worth of growth without even knowing whether we're going to have growth or not in the next few years. It's a complete mania and insanity, and Jim Cramer continues to egg on young traders to continue their risky and bad behavior. And here is a clear illustration of what's going on in the market and why the stock market is continuing to surge higher impulsively. And of course, in this channel, we revealed this last year. We talked about the gamma squeezes and the fact that the Robinhoodians are moving the market via options gambling. Nobody's buying stocks here. They're going all in, buying options, call options that is, and in turn, the bankers who are selling them these call options are buying the stocks. That is what's moving the market higher. And the bankers could give a rat's ass about your call options. They buy the stocks and they ride the ride higher. And at some point, when the show is over, they dump everything on your little head and they cash in their profits. I'm gonna make a video at some point titled Think Like a Banker. Instead of buying these very expensive call options, how about you think like a banker? You buy the stock instead and you sell upside call options. But here it is. Options feedback loop revives bust warnings in soaring stocks. And all of a sudden, the corporate news media are like, oh, now we know why the stock market is going higher impulsively. It's the options gambling mania. We've been saying this since last summer. Call buying has pushed quote-unquote gamma exposure to all-time highs. Friday's index option expiry will bring test. And of course, tomorrow is going to be a very, very important day for another reason, and I will discuss it in the conclusion of this video. And right away, you see from the chart right here that we are pretty much the gamma exposure at all-time highs. They're going all in, fully exposed, no insurance policy whatsoever. It has been working for them for a while. It's going to work until it doesn't. But the more this strategy works for the Robinhoodians and the likes, the more risk they're going to take. They're going to go all in one of those days buying weekly options out of the money, and the market's gonna crash on their heads, and all of that money gonna go away. Poof. You're gonna lose 100%. 100%. Options, if done correctly, could be the poor man's way to become rich. However, if done in this impulsive mania, it is the easiest recipe to lose everything. And here is the article. To some, the feverish call buying is fueling a bullish feedback loop in equities as market makers hedge their positions. This is exactly what I just explained to you. Market makers have to buy these stocks that you guys are buying call options on. NEO, Tesla, etc. And they're having a good time right now because these stocks continue to go higher. At some point, they're going to dump. Continuing, retail traders have stocked the frenzy, with JP Morgan Chase analysts noting that small trader call options buying has rebounded abruptly after the December seasonal dip, a sign of froth and bubble warnings abound. Stock markets may be sitting for an intense gamma squeeze, according to Susquehanna International Group. For some analysts, Friday's index options expiry will bring a test to the market. Continuing, dealers are short calls due to the unprecedented call activity previously mentioned, meaning that the Robin Hoodies are buying so much calls there isn't anything available. Market makers ran out of call options, and as a result have been forced to chase stocks higher to hedge. Chris Murphy, Susquehanna's co-head of derivatives strategy, wrote in a note to clients, quote-unquote, the unwind could potentially be violent. Given all excesses euphoria, it is more likely a question of when and not if. It's going to happen 100%. The Big Short 2.0 is coming, and it's going to be bigger than ever before. A shorting opportunity of a lifetime. Continuing with the article, that euphoria has morphed into full-blown mania just days into 2021. They're being very modest here, calling it mania. I called it arrogance, from euphoria to arrogance. With retail darlings such as Bitcoin and Tesla soaring 37% and 20% respectively already this year. But perhaps the most dramatic illustration of the day trader craze came on Monday, when 6 stocks priced under $1 per share made up nearly a fifth of the total U.S. volume. Jerome Powell, are you listening? You moron. Is this market functioning that you're talking about? Fifth of the total U.S. trading volume came for penny stocks. You cannot make this up. Continuing, that's in addition to the money traders have been shelling out in the options market. Over 18 million calls in sizes of 10 contracts or less were purchased in the first week of December, the highest ever, according to the Options Clearing Group data compiled by QVR Advisors. The chief investment officer of QV Advisor, Ben Effort, said, of course, just over 60 million calls were purchased in the first week of January. Wow. And my message to any young traders from the Robinhood crowd, if you're listening to this, please consider taking your gains, at least some of it. I promise you, you're not going to keep your money if you continue to keep doing this over and over again. Keep your gains. Take some off the table. Continuing, that pushed so-called gamma exposure to an all-time high. According to one measure that not every analyst considers gospel. It could climb even higher, with the President-elect Joe Biden's administration poised to usher in a new round of fiscal aid, aka more cocaine. And of course, Biden, this is going to be a disaster of an administration. He has no clue what's going on in the market. He's getting an economy that is already too hot in terms of the stock market. That will bust, the bubble will bust, and perhaps the stock market is going to do worse under Joe Biden, and maybe that will reflect into the overall economy. Who do you think is going to taunt Joe Biden on Twitter and bragging about his own stock market gains? Donald Trump. Oh, wait a minute. He's banned from Twitter. But he's going to found another media company, I promise you. Continuing, there will be checks that will likely spur even more frothy weekly options trading. Peter Scher, I don't know how you say his name, head of the macro strategy at Academy Securities, wrote in a note to clients, quote unquote, the put to call ratio is as low as it has been, and my social media streams are literally blowing up with daily and weekly options trading strategies. And if that didn't faze you, let's move on and continue our conversation regarding the penny stock mania that we started yesterday. Here it is. Newbies discover penny stocks and 1 trillion shares get traded. Wow. The reason is, of course, with the gamma squeezes, when you have a high gamma, highest ever on record in the options market, these options are becoming very, very expensive. The premiums are too expensive and they don't make any sense whatsoever. So the Robin Hoodians decided to migrate now to penny stocks because that is cheaper than buying call options and it is easier to create squeezes in these names. Again, I called them in yesterday's video, they're a bunch of zombies high on meth looking for the next score. While there have been many examples of volume explosions in low-priced New York Stock Exchange and Nasdaq stocks, in the last few months, a whole other ecosystem of speculation exists outside the regulatory reach of these venues, and lately it has been booming. Our past broker-operated venues where Robinhood trades get executed, it is lightly regulated quotation systems run by firms like OTC Markets, where more than 1 trillion shares in some of the riskiest companies changed hands last month. Remember, the Robinhoodians started this mania, and they're gonna end it themselves by backstabbing each other. Those who are pumping these penny stocks, and you saw it with the so-called Signal app. It was not actually the Signal app. It was a different company called Signal. And it popped over 12,000% and then lost over 50% in a single day. You're going to see pumps and dumps and a lot of victims here. The Robinhoodians are going to stab each other in the back, quote unquote. When you see all this stuff coming out and all these people talking about penny stocks and pushing them higher, it has got to make you wonder, where is the top? Is it too frothy? Is there too much exuberance out there? Said Ryan Newman, market strategist at Informa Financial Intelligence, Zypher or whatever. I think I went to college with this guy. Anyways, that's my concern. The fear of missing out is driving stock prices. Last month, low-price stocks that don't trade on classic exchanges, often confusingly called over-the-counter securities, saw more than 1 trillion shares exchanging hands. FINRA data shows. That is the first time in a decade such activity happened off exchange. And for comparison, amounts to almost 50 times the volume traded among securities in the Nasdaq Composite Index, according to Sundial Capital Research. It has gone full-blown now. A few months ago, we thought that this is the top for the mania, but they keep defying expectations more and more and more. They're zombies high on meth looking for the next score. They finished with the options market, now to penny stocks. What's next? Where is the next mania? And of course, here it is. It is clearly a bull market. He said, I would be very careful. We are definitely in a market where my cleaning lady is asking me, do I like solar companies? Because she bought a solar company that is a Nasdaq stock through Robinhood, and it's tripled. My prediction is a few weeks from now, this guy will be working for his cleaning lady. More on market sentiment news. With all the mania that we're seeing in the market, are they at least buying insurance? No, they're not. Here it is. The CBOE equity put-to-call ratio at the lowest since 2010. And you see it right there. No appetite whatsoever in buying protection put options for equities. They're all going all in, Naruto style, buying call options. What do you think is going to happen here? It is a matter of when, not if. And they're all arrogant enough to think that they will spot when the party's over. Think again. And it all goes back to the argument from the Federal Reserve that the mania is justified in equities because the low Treasury yields. That is your Papa Jerome is saying. Here it is. As Treasury yields rise amid expectations for growth, the key question on investors' mind is how high can they climb before spoiling the risk assets rally. Some Wall Street analysts are saying, 1.3, 1.2, around that range, and the party's gonna be over. Guess what? We are already at 1.13%. And I highly recommend that you watch a CNBC interview with Jeffrey Gundlach, because Gundlach says it's actually 1.5 and more. If we get to 1.5, the party is going to be over. But he also predicts that the Fed will deploy yield curve control measures. Needless to say, inflation will speak the loudest. The Fed can continue to manipulate the market via yield control measures, but inflation will stick a fork in their eye. They're going to have to print tens of trillions more to continue to prop up this zombie market. Trigger point looms for rising yields to upset risk assets. As benchmark Treasury yields rise amid expectations for stronger growth. That is wrong. We just registered over 900,000 people unemployed this week alone. Of course, this is the bullshit that if you go to college and you study macroeconomics, all these zombie professors are going to say, yeah, the rise in the 10 years yield is a predictor of more economic growth. Really? If that's true, then Zimbabwe should have the best economy ever. Yields are rising for the wrong reasons, baby. It is rising for inflation. Continuing. Some, such as JP Morgan Asset Management, worry about the pace of their ascent, while others are focusing on breaches of levels. From 1.3 to 1.6, the 10-year yield climbed to just above 1.1 Thursday after a report indicated that Joe Biden plans a COVID-19 relief package of about $2 trillion. The moves brought back memories of 2013, so-called taper tantrum, when yields surged on the disclosure the Federal Reserve was considering dialing back asset purchases, leading to a jump in volatility in financial markets. And we saw that again, by the way, in 2018. Why is that? The market is, say it with me, a cocaine addict. What is the cocaine? Fiscal and monetary liquidity. The market cares not about the pandemic or death or unemployment, nuclear explosions, asteroids hitting planet Earth and ending humanity. That doesn't matter for the stock market. The stock market cares about one thing, the cocaine. And any hint that the cocaine is going to be interrupted, the market would throw a fit and crash, and you will see the Wall Streeters and the 1% yelling and screaming at the Federal Reserve to do something. And of course, your boy Jerome thinks that he got all the tools. But here is the answer to all the morons who keep telling me, oh, the perma bears been saying that the market's going to crash in 2018, 2015, 2010, 2013. Here's the difference. The 2s to 10s yield curve continuing to creep back up now at 2017 levels, meaning that this time it is different because for the first time in a decade, we're seeing the 2s to 10s climbing higher. Meanwhile, stock market valuations from a PE perspective or forward PE perspective or whatever perspective you want to look at all-time highs. This is a recipe for disaster. And lastly, let's move on and cover some corporate specific news, starting with the newest IPO mania we saw in the market today. Poshmark prices IPO above range as public markets continue to YOLO startups. We're not in reality anymore. This is a whole joke. It is the video game market. And here is who's becoming richer, by the way. Not the Robin Hoodiots. The Robin Hoodiots are just having a sugar high for the moment. They're going to lose all of their money at some point. The Poshmark IPO just boosted CEO Manish Chandra's net worth to $500 million. Serena Williams stands to gain too. Why is that? Because Serena is an investor, early investor that is, in Poshmark. Here is smart money. Serena Williams buy the company or buy shares in the company way before the IPO when the company is dirt cheap. You morons buy shares in the company when it's priced at all-time highs. For example, NIO is now worth more than GM and Ford combined. They produce a fraction of what Ford and GM produce. And the argument is, oh, but NIO's the future, bro. Come on. They're going to produce more cars by 2030. Yeah, you're already buying the stock at a valuation that is pricing 2030 and beyond. Meaning, what is the outlook of growth beyond this one? You buy cheap, you sell expensive. You don't buy expensive hoping that you're going to sell at more expensive. And by the way, the new generation of investors, the Robin Hoodiots, they don't believe in selling. They believe in buying expensive and wait for your gains to go to the moon. And of course, their gains going to go to the moon and never come back to the Robinhood accounts. They're going to buy expensive, sell cheap. And here is another sign of the mania. Pet care retailer Petco shares surge more than 50% as it returns to public market. Wow. Now, this is a San Diego company where I'm based, so I have no complaints whatsoever. But really, Petco is the future, bro? What about Chewy? And remember the whole mania back in the dot-com bubble with pets.com? Well, we're back at it again, baby. This is much worse than the dot-com bubble. And here's the last bit of news I want to share with you regarding the souffle, aka Tesla. The NHTSA wants Tesla to recall 158,000 Tegra 3 equipped vehicles. And of course, Tesla voluntarily asked for the recall. This is the high-quality engineering in Tesla, by the way. Should we add another $100 billion to Tesla's valuations on recall optimism? Moving on to the heat map analysis, and let's see what's going on here. Any theme? Yes, there is a theme. The dollar declined slightly during Papa Jerome's interview. That helped some of the material names, specifically copper. Copper likes to party before the party even starts. And you see Freeport-McMoRan climbing significantly higher today. We talked about the 31 resistance for Freeport. Once you break that, it is a rocket ship that goes higher. Similarly, we saw energy stocks performing or outperforming the market rather, also based on the slight declines in the US dollar. Slight gains in the US dollar, and you see energy stocks trading in the red. We also saw Treasury yields climbing higher once again. That helps the banking sector, and you saw gains for Wells Fargo, Citibank, JP Morgan, Bank of America, and the regional banks specifically. The only underperformer here in financials, beside Visa and MasterCard, by the way, massive declines here for credit services. BlackRock declined about 5% for the session, but BlackRock had decent earnings. How could they not with the gambling mania in the stock market? But again, the stock was overpriced already, and you saw it giving up just a little. Now, what happens when Treasury yields rise higher? Technology, specifically the high valuation names, underperform, and you saw all the big tech firms declining significantly, specifically Facebook breaking the support level that we talked about yesterday, the 250. And you saw declines for the software names. Meanwhile, chips continue to outperform, and the reason is the chips shortage and the high demand. And we talked about the best name in the game here, Taiwan. TSM reported earnings and climbed over 6% in the green. It was much higher, by the way. Midday, it was up above 11%, but it finished the session about 6% in the green. Who cares if Nvidia does good, Intel does good, AMD, who cares? You buy Taiwan, they're going to manufacture those chips anyways. Taiwan wins either way. And we also saw some of the retail favorite names such as Zoom, Peloton, Airbnb, DoorDash, all these crazy mania names of the IPO surging higher. And when we talk about auto manufacturers, the money is shifting from the overvalued names such as NIO, Li, Xpeng, Tesla to where? General Motors and Ford. Massive gains for GM today, another day with gains almost 6%. Otherwise, mixed to muted action here for consumer defensives, real estate, utilities, industrials. Meanwhile, in healthcare, we saw some modest gains for Johnson & Johnson due to the announcement of their vaccine results. We're done with the vaccine optimism that is already priced in, regardless of what moron Jim Cramer says. Moving on to the charts analysis. What do we see here from a 15 minutes perspective for the SPY? No overnight pump. What happens? The market trades flat. Market participants are already all in. Absent of new stimulus, there is no money. We're already all in. So if the mysterious entity doesn't pop the market overnight, this becomes a seller's market, because some rational investors will say, all right, we're not moving here. The market's too high. Things are getting frothy. You see, the path of least resistance is actually to the downside. If somebody pulls the trigger, the SPY goes lower. All in all, we're still trading in range. Nothing happened here. Yes, it's a bearish closing, but you're not going to read a lot into it. We are looking now for two support levels. Two major ones. There are minor ones at around 377, etc. But the one I'm looking for is the 374. That is the first support. And then we have the 369.60. That is the second support. But make no mistake here, the SPY could go higher. And I can illustrate that to you via visiting the daily chart of the continuous contract. What are we doing here? We are still in a bull flag formation, trading above the trend line that was resistance and now support. Maybe we can go down and test it, but for now the SPY is bullish. You're starting to see a little loss of momentum here in the RSI, but again, you don't want to jump the gun here. Wait till the breach and the breakage of the trend line first if you want to short the SPY. Moving on to the Qs. What do we see here? 15 minutes perspective. Once again, no overnight pump, and you see the market trading flat to weak. Of course, as Jerome started speaking, the Treasury yields went down initially, but then they popped higher, and you saw technology names trading lower, the triple Qs in this case, breaching the trend line. And when we zoom out and take a look at the daily chart, we see that we have lower divergence here in the RSI and the MACD, and you're seeing that the Qs are struggling to hold to the trend line. It is very steep, and it requires overnight pumping to keep this ride going higher. Let's contrast that with small caps, the IWM. In the IWM, caught an overnight pump, and you see that the Russell outperforming for the day, closing almost 2% in the green. Again, absent of an overnight pump, the market goes nowhere. What does that tell you? Buyers exhaustion. Who's left to buy here at these prices? Moving on to the IWM daily chart. What are we looking for here? A breach of the upper trend in the RSI. We're looking for a loss in momentum. Absent of that, the IWM continues to rise higher. Moving on to the Dixie, what do we see here? We talked about the bull flag formation that is going on here, and you see that the Dixie is consolidating underneath the resistance line of 90.5. It is just a matter of time before we climb higher. The only thing that would derail a potential rally in the dollar index is the announcement of the new stimulus package from Joe Biden. More money supply, more money in the system, that will take the dollar lower. Meanwhile, what do we see here in gold? We're still consolidating here in what is appearing to be a bear flag formation. If we continue to see a rally in the dollar index breaking above the resistance line of 90.5, you bet that gold will go lower all the way to the levels of 1800. Let's see how the market's going to react to the announcement of the new stimulus package. Moving on to the TNX, the 10 years Treasury yield. And we were eyeing an ABC formation here, and I was looking at revisiting the level of 1% once again. That would be, of course, the B leg. But look at what's going on here. The TNX is already rallying without visiting the 1%. What does that tell you? It tells you, Jerome, go get lost. No matter what you say, you cannot have your cake and eat it too. Either you want inflation to go higher and sustain at 2% or higher, or you don't want it. Because if you want inflation, guess what? The 10 years Treasury yields are going to climb higher because investors are looking for factoring in inflation within the 10 years Treasury yield. Meaning that even if the Fed applies yield curve control, that might be successful in the beginning. But at the end of the day, the free market would take place. If you have high inflation, investors are going to look for higher yield. The Fed will have to be the only player on the table buying bonds with tens of trillions of dollars. And here it is, by the way, inflation expectations. The ETF for inflation expectations, the RINF, climbing higher and higher and higher. Inflation expectations are surging. Moving on to the VIX. What do we see here? Going back to the lower end of the wedge, catching support, closing higher. Are we going to see a surge higher tomorrow? My bet is yes, because it is monthly expiration date and there is going to be a lot of volatility here. So I expect the VIX to rally higher tomorrow. What about Apple? We talked about Apple yesterday for potential bull flag. As you can see, hugging the 131 resistance line. It got rejected and failed today. This is a bearish signal. It is not the ultimate bearish signal because we're still trading in range here, not doing anything for days when we talk about Apple. And more inflation expectations and a surge higher in the 10 years Treasury yield will pressure Apple lower. Let's move on and talk about Tesla. Again, we have nailed the reversal from the 84 RSI level. Now what? We're seeing a bearish flag formation, but you got to keep in mind that Tesla is just consolidating around all times highs. Tomorrow is options expiration. A lot of calls are already in the money. Remember the maximum pain theory. Option riders could, and I expect them to, dump Tesla tomorrow to make sure that they meet the maximum pain price. That is to make the majority of call options expire worthless. And lastly, an update on charts to watch. We talked about Kroger a few weeks ago battling the descending trend line and the resistance level of 32. We saw the break today and Kroger rallied significantly. This is not a tech stock. This is a grocery store and it's already participating in the mania. You see the name rallying over 3%. And disclaimer, this is one of my biggest positions in my portfolio. Traders, algos, they're looking at the same things that we're looking at here. The descending line, the resistance line. Once you break above it, you're going to have an impulsive rally. We saw that with Wayfair, by the way. We talked about the chart of Wayfair yesterday. I will try and review all of these charts to watch that we discussed through the week, during the weekend, and give you updates on all the charts. With that being said, let's move on to conclude this video. We had an announcement about the new stimulus package from the Joe Biden administration, and I think it's about $2 trillion with $1,400 stimulus checks. The rest of the money, the 1.9 trillion, is going to Wall Street, of course. But $1,400, you saw the mania that happened in the market by the $600 stimmies. Can you imagine what's going to happen to the market with $1,400 stimmy? Higher we go in the mania until things start to malfunction and the market crashes. You gotta watch the 10 years Treasury yield. Getting very close here to the tipping point. Furthermore, and this is perhaps the most important thing to watch for tomorrow, Robinhood is allowing expiration date options trading. The mania in Robinhood goes on. First, they're trading options via margin. That is a recipe for disaster. Second, now they're allowed to trade options during expiration date, so look for more and more volatility and look for more victims. Because if Robinhood's going to allow you to trade during expiration date and they're not going to close your position before the end of the date, some morons who think that they are experts in options trading would leave positions to expire thinking that they're expiring worthless by Friday's closing bell. What's going to happen is, if we see movements after the bell and even early on Monday next week, your options can be called away. So for the love of God, if you're selling options expiring tomorrow, or if you're buying options expiring tomorrow, make sure that you close all of your positions by the end of the day. Don't leave anything open, because if the market moves after hours and reach the strike price, your options are going to get exercised. I hope I'm clear here. With that being said, that's all I got for you today. I'll talk to you again soon. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.